Hello everyone. This is Blaine Thiederman with Progress Wealth Management. And today's video is going to be focused on mutual funds and how to invest in them. This is going to be more focused on the needs of beginners. So if you're a really experienced investor, you know all about mutual funds, you're probably not going to learn a lot. It's going to be mainly focused on people who are just getting started. Normally, most of the people that work with us typically are making a good living, they've got a good career or a successful business they own and operate, and they're just trying to figure out how to grow their own personal finances. That's the kind of person this is going to be focused on. Now, what are we going to be going over here today? So first off, we're going to talk about the basics. What are mutual funds? How do they work? And a bit about how to build your investment strategy. We're going to talk about how to think about how to build that portfolio as well, because it's important to not put all your eggs in one basket. If we bet the bulk of our life savings on the performance of the United States economy, it might turn out, but it also might not. And there's a lot of good reasons to believe that. Next off, we're going to talk about how to start investing, because figuring out how to set up the account, where to go, how to pick out mutual funds, that's going to all be really an important and a vital part of your process of growing your life savings. We're going to talk about the pros, and we're going to talk about the cons of mutual funds as well. So I hope this is valuable. Probably should take about 5 minutes, then you can get back to your day. All right, so let's get started here. Now, first off, what is a mutual fund? Well, a mutual fund is a type of investment that allows the pooling of money from different investors to invest in a variety of different kinds of securities. And a security is basically just some stocks or bonds, right? Now, imagine this. Imagine you, me, and 50 other people all have $1,000, and we all want to buy a lot of stocks, 1,000 different stocks, right? Needless to say, you probably couldn't afford to buy those 1,000 different stocks with just $1,000. Most stocks trade for more than $1. So it makes it easier for everyone to afford to be that one person and not be betting all on just a couple companies. So all of us could go in on these companies together through a mutual fund, right? Now, it gets a little bit more diversified and complicated than that, because literally millions of investors sometimes. But still, the point remains that you and a large number of other people all go in and buying a huge number of stocks, right? Now, the main advantage is, number one, it provides diversification. So if one of the companies you invest in ends up being a lemon, it's not a very good stock, you don't really even notice it. Now, in addition to that as well, you also benefit as the economy grows. You're not just betting on the performance of one company, you're betting on humanity if you're investing in literally thousands of different stocks. Your portfolio will grow with the markets. Now, this overall decreases your risk of, number one, losing money if you pick out a bad stock, and also your risk of missing out if the whole economy grows faster than the stocks you pick, because if you're watching this, you're probably not a professional. Probably hard to guarantee you're going to pick out good stocks, right? So that's why we like mutual funds. Now, how do mutual funds work? Well, like I said, you put money into a pooled investment, and typically from there, because it's not just into a 10, 20, 50 different stocks, you actually have someone who's a portfolio manager taking your money and picking out what kind of stocks make the most sense for that portfolio, given the goals of the mutual fund. So one mutual fund might invest in large companies in the United States. Another one might invest in bonds. You're basically lending money to companies who need debt, right? Another one might invest in tech companies or utilities companies or, right? Tons and tons of different objectives that these mutual funds can have. And that's what the portfolio manager's job is, to make sure that the fund fits its objective. Now, how to make money with mutual funds? Well, the first one is with dividends. Most companies these days want to give their shareholders a reward for owning their stock. They say, hey, shareholder, you own one of our million shares. We want to distribute $100 million to our shareholders to say thank you for owning our stock, so you get $100. There you go, $100 for you, right? That's called a dividend. That's a percentage of the profits they distribute. Next off, capital gains distributions. Throughout the year, mutual fund portfolio managers of mutual funds will say, this is a great stock, and you know what? I don't want to own this other stock anymore. So with that other stock they don't want to own, they might sell it. And when they sell it, they might sell it for more than they bought it for originally. And they have to pass off those capital gains to their shareholders as well. So when they sell a stock for more than they originally pay for it and they make a gain, they take all that money they gained and they say, hey, person who owns a few shares on a mutual fund, here's your proportionate ownership of the gain that we just earned, right? And then the last way, of course, we all buy mutual funds because we want the mutual fund to grow. We buy it for $100, we hope to sell it for $200 or more per share. And when you buy it for less than you sell it for, eventually, you make money, right? That's about as easy as it goes. It's about as simple as it is. So no different than if you buy a house for $100,000, you sell it for $200,000 sometime in the future, you made $100,000. Well, it's the same thing with a mutual fund. You buy a mutual fund for $100,000, eventually, hopefully, you can sell it for more. Now, the average rate of return of mutual funds over the last 5 years is 6.92%, and that's of all mutual funds out there. That's per year. Now, needless to say, some mutual funds are very conservative, some are very aggressive. This is the average. Okay. Now, also keep in mind, this is the middle of a time where we've had a little bit of a bear market. So this number is typically quite a bit higher if it wasn't in this kind of market that we're in right now. Now, next off, moving on to strategies for managing your portfolio. So, of course, you can't just buy one mutual fund with the bulk of your life savings and say, this is good, I'm going to stick with this forever. No, your portfolio has to have more to it than just one fund. Because like I said earlier, you put all your eggs in one basket and you drop it, it could ruin your life. Now, when you're building your portfolio, it's really important to remember that you have to start off with your goals, right? A lot of people think, well, of course, everyone wants to just grow their money. That's not actually true. Some people are not looking to grow their money with mutual funds. They might be looking for a variety of different goals. Now, if you're in your 20s and you just graduated from college, you probably are an aggressive investor. You probably are just concerned with trying to grow your money as fast as prudently possible. If you're in your 30s or 40s, that's probably pretty accurate as well, unless you've got some other financial goals in the short term of things. Now, if you're a moderate investor, let's say you say, hey, Blaine, I want some growth, but if my portfolio drops in the middle of a recession, I don't want it to drop very hard, and I want it to come back pretty quickly, and I'm willing to sacrifice a little bit of growth in the long run of things to make it so that I can sleep better. You'd probably be a moderate investor, right? Now, moderate investors have bonds and stocks in their portfolio, mixture of the two. And the whole goal, like I said, is to make it so that the ride to get to retirement or your financial goals is a bit smoother. You don't feel as bad. And that can make things a lot easier for you. The average rate of return of investors, as per the Dalbar study, is 7.7%. The average rate of investors that use a financial advisor is closer to about 10%. That's a huge difference, massive difference. And the main reason is not because investors don't have the same tools that financial advisors do. It's because investors out there that use an advisor are more disciplined. They make fewer mistakes on the way to their financial goals. Okay? Now, the same remains here. If you don't have the discipline, you don't have the guts to be an aggressive investor, that's not a problem. Be a moderate or be something else, right? If you can't handle markets going up and down, if you can't handle the truth, then by all means, try to be investing the same way that your gut says you should. And then lastly, conservative investors. I talk to a lot of people that say, Blaine, I want to beat the cost of living by a little bit, not by a lot. Or maybe they might say, Blaine, I want income. I don't need to grow my money. I've got a lot of money. I just don't want to have to sell. I just want to keep it all invested until I get into my 80s or 90s. I might need it for medical bills. Well, that means you're probably conservative. And people that are conservative investors typically have very small amount of money invested in stocks, if much of any at all. They're normally more invested in fixed annuities, bonds. The portfolio they invest in, it doesn't grow very quickly. It's mainly just there to put along, hopefully beat the cost of living by a little bit, make sure that they can afford their medical bills. If the cost of medicine keeps going up at 5 to 6% a year, right? They want to make sure that they're not going to run out of money. but it's not trying to grow your money aggressively either. Now, when you're picking out mutual funds, it's important to understand the fees, because there are a lot of different kinds of financial advisors out there, a lot of different kinds of mutual funds. And some funds have these commissions built into them. These commissions are not small by any measure. So imagine this. What if you put $1 million into a mutual fund, and the financial advisor that recommended it to you, he charged you a 5% commission just for recommending a couple funds? That means you pay him $50,000 in fees. That's insane, right? Just for saying, yeah, I recommend these funds. Does a doctor even make that? No, probably not. Does that advisor have some unique skill set to pick out the best funds ever? No, he doesn't know the future any better than you do. So he's mainly just charging that commission because he's a salesman, right? Are the funds that he recommended any better than any others? Probably not, right? This is part of the reason why Progress Wealth Management likes no-load funds, likes exchange-traded funds. These have no commissions or sales charges. And unfortunately, fees really matter because the financial sector is filled with people who are trying to charge you as much as possible. And we think that's wrong. We think that if they're charging you, they should have earned it through helping you grow your money more effectively than you could if you went to a robo-advisor. They should charge you because they helped you save money on taxes, improve your financial plan for the future, improve the quality of your business, help you get a raise at your job. These are the kind of things they should be charging for, not just to say, I think you should buy these 5 funds, right? A computer told them what funds to buy. They weren't super smart. Now, how do you maximize your mutual fund investments? Well, we believe, like I said, number one, use no-load funds or exchange-traded funds. These are low cost. These typically don't really have a whole lot of drawbacks. They do what they're supposed to do. You put your money into an index fund that has no big commission on the front, and guess what? It invests in the index. It's great. It does what it's supposed to do. And historically, over 35, 40, 50 years, no portfolio manager has ever beaten the S&P 500 consistently, right? Over the long run of things. You might see a couple years where they get lucky, but they're not as smart as they like to tell you they are, right? Now, we also believe in dollar cost averaging. Now, this is not saying dollar cost averaging will produce better returns. It's not saying that you should keep your money in your bank account because that's the best place to put it by no measure. If you have $100,000 in your bank account, probably should invest it considering your goals and your time frame, right? If you don't know what that means, contact us. Happy to help you for free. But for a lot of people, dollar cost averaging, the main benefit behind it is that if you have a monthly contribution to the funds that you want to go into, because that's what dollar cost averaging is, every single month, you put the same amount into the same mutual funds. And as a result, you're not paying attention to the price or the movement. You're trying to buy the low, sell the high, right? It helps you have a behavioral advantage. It helps you stay more disciplined. It helps you not think about the prices that you're buying and selling at. And the main benefit behind that is that you're less likely to try to get out at a bad time. You're not thinking about it. So the behavioral advantage is massive, and it helps you stay more disciplined, which could be worth 1, 2, 3% more per year by you just avoiding making mistakes, thinking you can time the markets. Right? If you don't think that's possible anyways, then great, put your money in. If you think that's possible, use dollar cost averaging. Now, how do you start investing? Well, first off, let's figure out your objectives. So if I was to say, so tell me, how would you like your portfolio to benefit from working with a financial planner or an investment manager? And you said, Blaine, I need more money. I'm poor, or I'm not poor, but I just need more money. Well, needless to say, that's your objective. You need to grow your money as fast as prudently possible. On the other side of things, you might say, Blaine, I'm worth $5 million, but I'm terrified to sell. Well, maybe your new goal, instead of growing it as fast as prudently possible, is to just generate income, right? Or tons of different goals. You might say, I want to grow my accounts conservatively, right? Now, next off, you have to determine your time horizon. So if your time horizon is 40 plus years until you're going to retire, and you say, Blaine, I'm poor, you're probably an aggressive investor, right? Or if you say, it's going to be 5 years until I need my money, and I still want money to grow as fast as prudently possible. 5 years is not a long time. The tech bubble back in early 2000s, as you might remember, took about 5 years to come back. If you put all your money into stocks in 2000 and you were going to retire in 2005, you'd probably be pissy. You'd probably say, this sucks. I wish I wouldn't have done that. But if you went to a slightly more conservative portfolio, your account would have rebounded faster. So consider your time horizon as well. Now, one that I didn't include in here that I think is really important is also try to figure out your risk tolerance. There's a risk tolerance questionnaire on progresswealthmanagement.com. You go to progresswealthmanagement.com, go to the bottom, click Form Center, then risk tolerance questionnaire. And by filling that out, we can help you figure out what your risk tolerance is for free. Not a problem, right? And then lastly, build your portfolio by picking out a few funds that invest in different things. Now, when we say different things, this might be bonds by using a total bond index and total international bond index. This might be investing in real estate with a small piece of your portfolio, something like a real estate investment trust or. This might be investing in total market indexes, which is investing in large companies, mid-sized and small-sized. This might be investing in long-term and short-term government bonds. It really depends on a lot of things, what portfolio you build. But just keep in mind, more aggressive investors typically have more stocks. More conservative investors typically have less as a percentage of their portfolio. If you're not sure how to build it, I can't say everyone build your portfolio this way because there's a lot of ifs, ands, maybes, and sometimes. There's no rule of thumb in financial planning, no differently than there's no rule of thumb in healthcare, right? Or your profession. If you're trying to help somebody, you need to ask them some questions first to give them the right advice, right? Now, what types of mutual funds should you consider? Well, the first type is a money market fund. If you have something you want to spend some money on in the next 2 years, a money market mutual fund might make sense. Treasury bills right now are paying almost 5%. Can't get that in a bank account anywhere, and those are basically risk-free. So money market funds are basically a bank account in a lot of ways. They pay you a very low rate of interest, but your money's ready at any moment in time for you to spend it. That's the beauty of a money market fund. This is typically going to be used as a holding place before you either A, you invest it, or B, you use it to buy real estate. Next off is a bond fund. Now, bond funds, they can be pretty good. Bond funds, when you invest in a bond fund, you put your money into, what do you know? Bonds. And bonds basically are debt. Major companies and governments throughout the world will sell bonds to the public because they need financing. And selling it to you would give them a lower interest rate than a bank would charge them. And as a result, it makes a lot of sense to go into to sell some bonds as opposed to going and contacting the bank and saying, I need a $100 million loan. Next off, a balanced fund. That's typically a balance between stocks and bonds. If it's balanced perfectly, what percent do you guess is in stocks and bonds? 50-50. Right? That's what a balanced fund is. And lastly, stock or equity funds. This is investing in the equity that a company owns in itself. Right? So if you buy equity in a house, of course you own equity. And there's equity plus debt equals the value of the home. Right? Same thing with equity in a company. Equity plus debt equals the value of the company. You can own a chunk of that equity. Now, what are the biggest cons of mutual funds? Well, first off, hidden fees and sales charges. The dark clouds are descending over the skies. In reality, all that's really referring to is something called an expense ratio and loads. Expense ratios are something most people don't realize they pay. So let's say, for example, you have an expense ratio of 1% and your mutual fund goes up 10%. Well, how much do you get to keep? 10 minus 1 is 9, right? Now, are expense ratios dark and evil? Absolutely not. We have to pay them because this is what pays for the attorneys, the accountants, the portfolio manager, the traders, the paperwork, so on and so forth, the overhead, the computers, everything that's necessary to operate a mutual fund. You can't buy a burger without paying for the ingredients, right? There's no way to get out of paying an expense ratio. So that I don't consider evil. Sales charges, I think sometimes these can be a little evil. There are a lot of advisors out there that say, I'm not paid. You don't have to pay me anything. This is free. And then they charge you a 5% commission, possibly even an 8.5% commission. That's the top of what's legal. And they don't tell you they're going to get paid that. They say it's free to you. That's a lie. It's not free to you. If you work with a commissioned financial advisor, they charge you a commission. They don't charge you anything, but the mutual fund company charges you a disproportionately high fee. And in turn, they take a big chunk of that fee and give it to the advisor. And they say, hey, thanks for selling our mutual fund. Here's 5% of this person's life savings. And they go, sweet. And all they did was just knock on doors and kiss babies and rub elbows with strangers, right? We think that's wrong to lie or to mislead someone and say, I'm not paid for this. Of course you are. Finance is not a nonprofit industry, right? The next big con is a lack of liquidity. Liquidity is something that's necessary in life. If you can't get your money out of an investment and you need it out, well, needless to say, that could be a problem. Now, when I say lack of liquidity, there are funds out there that sometimes do have lockup periods, right? Hedge funds are a great example. It's a kind of fund, or it's a pooled investment just like this. Poor trade execution. Some mutual funds have really terrible execution. So when you buy stock, you might be paying a higher price than you would if you bought it for a different mutual fund. And lastly, tax inefficiency. Now, every single year, you might remember me talking about those capital gains distributions. You don't have control over that. So what if they end up buying and selling for a gain and send you $100,000 in gains? Well, that could be really, really bad. Because what if this is a bad year to have that much taxes? That could be a problem. So I appreciate everyone listening to this presentation on mutual funds. I tried to make it less than dry, but I'm not sure if I was successful. So with this, Progress Wealth Management, we are a fee only, so we're non-commissioned. We're fiduciaries, meaning that we're legally bound to prioritize you over ourselves at every step of the way. And we're specialized in helping people who work in tech and small business owners. This is our two focuses, and we believe that we're really, really well qualified to help these two groups because we can help you improve the management of your business. We can be your fractional CFO just as an ancillary service. We can help you save money on taxes. We can help you invest better. We can help you do so many things that are specific for people like you. And I hope this was valuable. Our team here is number one, Colleen Beckemeyer. She's a certified financial planner. My name is Blaine Thiederman. I'm the founder of Progress Wealth Management. I'm a certified financial planner. I've got a decade of experience helping people with their finances. And lastly, Vasil Bechev. He's our tax expert, and he's a specialized expert helping people with rental properties, small businesses, and equity compensation. Now, if all of this was really valuable, I hope it was, if you have questions, you want to learn more, you can contact me directly at 425-577-0660. We're available 8 a.m. to 6 p.m. Monday through Friday. That's Mountain Standard Time. You can visit our website and schedule an appointment at progresswealthmanagement.com, or you can just send me an email. We're not salesy, so if you have questions, don't worry. We're not going to start trying to strong-arm you into doing anything with us at all. We don't even accept most clients. But still, regardless, we hope this was valuable. Thank you, everybody, for your